Right. So we're going to start off with chapter 5, which is on residency and source. So, who is a taxable person? What is meant by taxable person? Under the UAE corporate tax law, the taxable person is either a resident or a non-resident. We'll see that the taxable person can be a juridical or natural person. This has been defined in Article 1 to whom the corporate tax law, UAE corporate tax law applies. And then when we reach Article 11, that's how the article starts off. A taxable person under the UAE corporate tax law is either a resident or a non-resident. So the entire world of taxable persons is divided into the two categories. First category, resident person. Now, please see that the word resident, R is also capital, person is also, I think in the decree law, it is capital. So anyways, a resident person includes UAE incorporated or recognized juridical person, meaning legal person, including the free zone person. Now there is a catch here. When they use the word including free zone person, do you know what is the catch in this expression?
No.
The definition of free zone person includes even branches which do not have their own separate legal identity. Their identity is an extension of their parent company, their mother company, the main office. So from a legal perspective, branch is not not a juridical person really. The mother company of the branch is. So anyways, I hope you get this point. All that there's a divergence, in the tax law, even a branch is being considered a juridical person. Why? Because of the virtue of the main entity of the branch. So that's one category, all incorporated or recognized juridical persons. That's the first category. Foreign juridical persons managed and controlled in the UAE. You must have heard 100,000 times the word poem, poem, poem. Have you?
Place of effective management.
Correct. So that's the entire, this line represents poems, place of effective management in UAE. So it is a foreign company. It is not incorporated in UAE.
But completely controlled from UAE.
Managed and controlled in UAE. Then,
Okay.
okay, yeah. So these two we had earlier on seen as juridical persons, right? Why? Because one more important point that we should always remember is that free zone person can never be a natural person. It will always be a juridical person, right?
Hmm.
The third category is natural persons conducting business or business activity in UAE. Natural persons, whoever are doing business, taxable business, they can be resident persons, but if they are originally residing in UAE, then naturally conducting business activity in the UAE, and others as decided by cabinet, which is a continuing provision. So this was the broad definition of the resident persons. Now, tax residency of a juridical person. Now we are coming to the legal entities only. A juridical person shall be considered tax resident in the state, meaning UAE, in either of the following cases. It was incorporated or formed or recognized in accordance with the legislation in force in the state. So that this is the only this is addressing only the juridical person, and that does not include the branch that is registered by a foreign juridical person in the state. Does not include. The key point is that if a foreign juridical person has a branch in the state, it will not be recognized. But we need to always remember that earlier on we talked about the fact that free zone persons are still considered, they can be resident persons if their place of effective management is in UAE. That does not include the branch, but we should also remember that branch uh, is a scenario. Branch is a permanent establishment. We're going to read the definition of permanent establishment. The fact that a branch exists, the fact that a branch exists in itself is an indicator that this is the presence of a non-resident person. So we should also, this also gives an interpretation that even though it is written that including free zone person, resident person includes free zone person. But will that mean that even the branches that are located in a free zone person are also considered in there? The answer is no. Why? Because the branch is actually only an extension, a taxable presence in UAE. We're going to read this point a lot more in detail in permanent establishment. And whenever the word permanent establishment comes, it will always point towards a non-resident person. Because if there are branches by a resident person within UAE, where that will be a bit funny thing to say that a company is incorporated in UAE, so and it has a branch in another, let's say, Emirate. So shall we even consider the question of giving them two different taxable identities? No, it doesn't make sense, right? If it is a branch of a UAE company itself, then there is no question of two separate identities. Branch is an extension of the original mother company. Do you understand what I have just tried to highlight regarding branches?
Yeah, I understood.
Okay. That does not include the branch that is registered. It is considered a tax resident in accordance with the tax laws in force in the state. So, yeah, I mean, which is the federal decree law number 47, this law that we are studying. So, if these conditions are met, then a legal person shall be considered a tax resident of the UAE. But that was for legal person. But what about natural person? Natural person discussion is a bit more detailed. Relatively easier to determine the tax residency of juridical person, but natural person may have a bit more complication. Although the natural person may not is not subject to tax on his personal income, only business income in UAE. How do we address the tax residency of a natural person? That the a natural person shall be considered a tax resident in UAE where any of the following criteria is met. So there is a criteria provided. First, primary abode and vital interest of a natural person, meaning this is meaning the life that the person has. The what are his most important priorities in life? Where does he live? First of all, right? Where has he opened his main, business or the majority part of his business? That's vital interest. Primary abode, usually where the family is. Uh, you'll see, I mean, maybe you might not read in the book, but there's a famous Israeli court decision regarding primary abode and vital interest, where it was very tricky that a person whose family was living in Tel Aviv and his economic interest, the business was also somewhere. So there was a tiebreaker test performed by the court, and ultimately, the very interesting decision that came was that because this man's family lives in Tel Aviv and their the entire life and his children and all that, it is so based on the primary abode criteria, that person was decided and determined as a tax resident of Israel. So it's a
That's a lot
famous.
many places, I believe, not only in Israel. There are a lot of other places, similar pattern they follow for the taxes.
Yes, similar. And do you know why is it similar that they follow? Because Model Tax Convention 2017, which is widely accepted by majority country in the world, when they they gave the Model Tax Convention, the
Mhm.
double tax treaty, model treaty, in the
Mhm.
discussion of that convention, when the tax residency of natural persons was being discussed, exactly these criteria came there. So it is a that's why it is so much widely accepted. You rightly pointed out.
But DTA does not override this rule, right?
double tax convention. See,
Yeah.
you will find that usually the double tax convention will be in line with this rule. But theoretically speaking, let's say if that double tax convention does not exactly align with this rule, okay, then what will happen is that since the double tax convention has been signed under Geneva Convention on the law of treaties, and the Geneva Convention clearly says that the any treaty signed under Geneva Convention will override the domestic law. So in that particular case, the double tax treaty will prevail over this decree law. Understood?
No.
So if there is a court decision to be made and the double tax treaty says something different, but your UAE decree law says something different.
Mm-hmm.
So whose side the court will side with? Double tax treaty or the domestic decree law? If that country in which this question has arisen, this court case is presented, if that country is a signatory to the Vienna Convention, na,
So they should agree with the DTA.
then they will agree with the DTA. If that country hasn't signed the Geneva Convention, then anything can happen. Understood?
So
So
in this case, that what you're saying, the point number one, uh, even though the family or like, other things which is fall into place, but still DTA will override the first point.
if the DTA, usually you will, that's what I'm trying to tell you. This is exactly what you will find in the DTA as well. It is
Oh, okay.
properly called a tiebreaker clause, my dear. Remember this. You will see this in the Model Tax Convention in the discussion of all of a resident person, etc. It's a probably number four, clause number four, I think, for on the resident. Do you want to see that? I can open it for you if you want.
Yeah, please.
Okay, hold on a second. So this is another publication of mine, which is kind of a summarization of. It's a huge document. Uh,
Including of tax case laws.
yeah. So, anyways, I would want to go directly to uh, resident. Yeah, there you go. Uh, this is Yeah. So you see this? This is the uh, I just like globe rules for the model tax convention, which is almost 658 or something pages document. Initial few are only the provisions. So provisions are smaller, 30 odd provisions are there. But then there is
Mhm.
very detailed commentary on it. Okay. So you can see here a resident of a contracting state includes any person who's liable to tax in that state based on domicile, residence, place of management, similar condition. And when we go into further discussion of this, for natural person, you'll see that the let me check where the abode condition is mentioned. Yeah, I think you can see. There you go. Can you see this? Habitual
Yeah, yeah.
treaty article paragraph 2. This is the tiebreaker clause that I was talking about, right? So
Mhm.
when we go into this, purpose of the tiebreaker clause it applies to the individual that is resident of both contracting states under Article 4. Okay, so this is where this matter has been addressed. It determines which single state the individual shall be considered a resident of for treaty purposes. So permanent
Mhm.
home, you can see permanent home, center of vital interest, habitual abode. Now, this is not his main habitual abode, where he spends his most of the time habitually, right? Nationality.
Mm-hmm.
So, final, mutual agreement. So, if this is what you see here, A, B, C, D, this is considered as a tiebreaker clause, and this is the exact sequence in which it is applied. So based
Mm-hmm.
on this sequence, first you see where is the permanent home, then see where is the vital center of vital interest, where is the habitual abode, and then nationality. The funny thing, right? Nationality comes at the bottom, right?
Yeah.
Yeah, and then even if we are not able to achieve the consensus on this, then finally there is another thing provided in the double tax agreements called mutual agreement procedures, where Federal Tax Authority and ZATCA will sit together and they'll decide, okay, how do we solve this? Let us solve this. That's called mutual agreement procedure between the two tax authorities. Clear? Shall we move to the original topic that we
Yeah.
were discussing? Okay. This entire document is called this is commentary on the double tax agreements. It's a model tax. It's a very detailed document. The entire world follows this document basically for double tax agreements under Geneva
Mm-hmm.
Convention.
Okay.
Okay. So, right. So what we saw here, where any of the following criteria are met: primary abode or vital interest of a natural person, the physical presence of any natural person, physical presence of a UAE or GCC national or residency permit holder. Okay. So we will go into a little bit more discussion of what we have just seen. That this is the criteria. This is actually the similar thing is in the tiebreaker as well, clause as well. Primary abode and vital interest. That's the first part. A natural person shall be a tax resident if now here we have to be careful because this is domestic law. This is not international law. Okay. So in UAE, the from a domestic law perspective, a natural person is tax resident if UAE is his usual or primary place of residence. You remember what was the first criteria that you saw in that document? Permanent home. Remember?
Yeah.
Permanent home. And then there was something, then the second one was probably vital interest. Third one was habitual abode.
Yeah. Family.
Yeah. So these were that was the sequence, tiebreaker sequence. So
Mm-hmm.
UAE is his primary, usual or primary place. Now here, the usual is actually the third criteria in the international tax law. Usual was habitual abode. Yeah. Primary place, that was the number one criteria, permanent home, where the natural person habitually or normally resides, where he spends most of his time when compared to other jurisdiction. But in either case, it is both are still part of the tiebreaker. UAE is the center of this was the second criteria in that document, Model Tax Convention. Remember, vital interest. So vital and economic interest, where the natural person's personal and economic interests are closest or of greatest significance to the natural person. So in an actual scenario, cannot take the name or disclose the client. We were deciding, we were like brainstorming about the tax residency status of a natural person from um, my country, and we, actually devised a strategy in line with the Model Tax Convention, considering that tiebreaker sequence itself. That do you have home? Do you have houses in Pakistan and UAE? He said yes. Oh, so that means we are compromised. Both places are, you have the property is here in both places. But where does your family live? Right now they're in Pakistan, and but I want them to, I want myself to become the tax resident of UAE. Then I said, okay, then probably it's a good idea that you might consider bringing your family into UAE, because then it will become your the family will be here, your property will also be here, then chances are that you will be
End
considered,
up paying tax. Yeah. Tax resident.
yeah, yeah, you will get the tax residency here in UAE, like that. So it was a
Mm.
kind of, sometimes you can maneuver around things in this manner as well. Okay.
But in the case, like, if in case that the family still lives in Pakistan, he has a property in Pakistan, he only lives in UAE.
Hmm.
still it will be taxed on both the side, right? Like you will be taxed in UAE. I mean, if it's going to be anything taxable, and according to the Pakistan law, there will be taxed on whatever income that he's been generated across the globe, right?
Yeah, so domestically, the law is going to UAE, sorry, Pakistani tax law, first of all, when the application of Pakistani tax law is happening, they will tend to ignore the double tax agreement. They will simply
Hmm.
apply whatever is there in the domestic law, just
So
like
it will be taxed on both the income. I mean to say, it will be taxed only on the complete revenue of the Pakistan, or it will be also taxed on the UAE revenue that he generates.
you need to first of all understand that there are two different types of income that we are looking at for when we talk about a natural person, and that is personal income and business income.
Hmm. Yeah.
Two different matters, right? So,
Hmm.
um, it, for an individual, both things have been addressed. That tiebreaker clause that we saw. It is not only for the personal income; it can be for the business income of the individual as well, right? For both perspectives.
Yeah,
So,
yeah, yeah.
right. So, the uh,
Yeah, for an
the
example, a person can be working in UAE just as an employee. It's a personal income, right? And they can be also a person who can be
Yeah, let
doing a
me
business.
complete. Let me complete. So I'm trying to answer your question, but let me first of all complete my answer. The what the question was that he has income in both countries, or how does that get taxed? So the answer is that the domestic authority is probably in at the outset they are going to ignore the double tax, the international law or the double tax agreement. They're going to simply apply, they know only the domestic law at an operational level. They're going to apply that. So if there is
Hmm.
Pakistan source income, the Federal Bureau of Revenue is going to apply the taxation on that Pakistan earned income, right? Because of they will see that this person is living in Pakistan or partially living in Pakistan. He has a national tax number, whatever from a UAE perspective, UAE, if there were any income which that individual is earning from UAE, the UAE tax authority, federal tax authority, is going to try to tax that person. Now, we both know that in UAE, personal taxation is not taxed. Personal income is not taxed. But
Yeah.
so the authority can only consider or look at whether the person has revenue in UAE or not. And if there is revenue at an individual level, the individual is conducting business under a sole establishment license, etc., which is still considered a natural person, that revenue will become subject to UAE taxation. Now, okay, fine. So we have discussed until that point. But then the domestic law of either country, and most of the countries of the world, except for certain countries like USA, they don't tax worldwide income of the individuals. USA does.
Use it as US. Yeah.
US does, but other countries they don't. So if at an individual level also, uh, even if the authority is aware, UAE Federal Tax Authority is aware that there is income of this natural person from Pakistan, they're not going to tax it because it is out of the scope of the UAE corporate tax law. Same thing in Pakistan also. But I don't remember the law of Pakistan right now. But chances are that it will be the same thing in Pakistan also. That they're going to ignore the income of that individual, which is not Pakistan sourced. It is out of Pakistan. So
Even if he's an employee or doing in business, right? Both the income for a
yeah,
Pakistan.
yeah, both
Yeah.
things.
Okay. Okay. Okay.
The tax authority in Pakistan is going to consider only Pakistani source income itself
All right.
for that individual. Okay, now
Okay.
that was the application. Now, if let's say the guy did not want the tax to arise in Pakistan at all, and he claimed that actually I am a tax resident of UAE, then that will become a question mark. That if this person is not our tax resident, then how do we deal with his income? That is where double tax agreement will come into play, and that is where they will try to analyze this person has been living in Pakistan. So why are we not considering him as a tax resident in Pakistan? That's where, as a defense, that person is going to bring the double tax agreement. He's going to say, look, this is that double tax agreement which the government of Pakistan has signed. So you guys, whether you know it or not, but please consider the clauses in there. And that's where the tiebreaker clause and all that discussion will start.
Okay.
Okay. So, okay, there's one more: physical presence by any natural person. A natural person can be considered a tax resident in the UAE if he has been physically present in the UAE for a period of 183 days or more. So this is exactly half of the year, correct?
Within 12 months, right? Within 12-month time period, right?
Yeah, that's what the next thing says. Within the relevant 12 months, 12 consecutive months. Okay. This is ministerial decision number 27 of 2023, as well as cabinet decision number 85 of 2022. Physical presence of UAE or GCC national or a residency permit holder. Now, this is another very interesting angle. Now, we're talking about UAE national or a GCC national or even a residency permit holder, meaning people from India, Pakistan, and other countries of the world who hold a valid residency in UAE. Okay, so what about their physical presence? A natural person shall be considered a tax resident in the state if he has been physically present in the state for a period of 90 days or more within the 12 consecutive months. So 90 days. So if somebody holds Emirates ID, the one criteria that would become applicable is 90 days stay in UAE. Clear?
Yeah. But why physical presence? What does it differentiate from the 12 months period? Oh, it's 183 days or 90 days, is it?
Yeah. 90. See, this is only those people who are either UAE nationals or GCC nationals, or they hold a valid residency permit. But before what we read, there was no mention of these three categories. So this is a global level. This is the default level, provision. But the
Hmm.
exception will come into these three categories. Uh, Globally, these are the rules: 183 days presence in the last 12 months. That's the global rule. That's a high level rule, default rule. Exception to that rule is if that person is a UAE national or a GCC national or a permit holder, residency permit holder of UAE. In that case, then we are going to see whether this person has been in UAE for 90 days or not within the last 12 months. That makes a life a bit easier as well if you really think about it. 90 days is I mean, the person does not have to be 6 months here. I know in certain countries of Europe, the requirement is 6 months, but the timeline is also longer. I think within 2 years or no, 1 year. Within 1 year, the person has to be in the state for 6 months, right? Something like that. But anyways, uh, within the last 12 months, this guy, he is either a UAE national or a permit holder, hold the nationality of the other GCC states, and he meets the following: has a permanent place of residence, either permanent place of residence in UAE, carries on an employment in UAE or business in the state. So either he's taking employment income or he has business in the state. So if any of meets any of the following: one, two, three conditions, any of these conditions is met, the person uh, will become a tax resident of UAE. Is there any concern or clarification needed on this?
No, no.
Okay, disregard of physical presence due to exception. Okay, fine. Yeah, there can be circumstances where a person either was stuck in UAE or outside UAE. Any day that the natural person's presence in UAE was due to an event or situation beyond the control, exceptional circumstances, may be disregarded by FTA in determining whether during the relevant consecutive 12-month period any natural person stayed in the UAE for 183 days, or UAE or GCC national or UAE residency permit holder stayed in the UAE for 9. So basically, it is simply saying that the UAE Federal Tax Authority will bend the rule or become a bit flexible with respect to the 90-day rule or the 183-day rule if if because of circumstances beyond the control of the person, it was due to an event or situation beyond the control, exceptional circumstances. It may be the it may be disregarded. Any day in the natural person's presence in the UAE may be disregarded. So after resident person, now we're coming to the topic or discussion of non-resident person. As the name suggests, it is a person who's not a resident. Non-resident person is anyone who does not meet the resident definition and has a UAE permanent establishment or earns UAE sourced income or has a nexus in the UAE. Now, there are three things mentioned in here, right? First thing, okay, fine, that's a generalistic rule that it does not meet the definition of resident person. So by default, everyone who's not a resident will be a non-resident person. But then there are three more indicators, very strong indicators given, because that person has to have an income, right? The whole point of discussion about resident, non-resident is from a taxability perspective, right? So how does a non-resident get taxed in UAE or for that matter in any other country of the world? So on an international level, on a kind of a globally accepted level, a non-resident person, first of all, we need to make it simple for like a layman. That non-resident person will be taxed in any country because of his taxable presence in that country. Does this make sense what I've just said?
Yeah.
Right? Taxable presence. Now, okay, if we know this default rule, then the second question we should be asking ourselves is, how does this taxable presence, what shapes or what forms can this taxable presence take? That
What are the
answer,
other forms?
sorry, what are the?
What are the other forms that the taxable, it can determine a taxable?
No, all forms, not only other forms, all forms. Why? Fundamentally, I'm talking about the taxable presence. Okay, I will not tell you that. Let me ask you yourself. So if we know that one company, for example, is a non-resident company, it is not only formed in India, but the entire board and shareholders, everyone sits in India. So place of effective management is also India. It is definitely 100% a non-resident person for UAE perspective, right?
Mm-hmm.
What different forms the taxable presence of that company could take in UAE? Can you please think and brainstorm and tell me?
Yeah, if they earn a revenue
Mm-hmm.
from the state of
UAE, yeah.
UAE,
Okay.
that could be one reason.
Okay, no, but hold
If
on a
they have
second.
an
So
agent
that's the guideline. So how do they earn that? That's my question. Do they
through
have
an
a
agent,
through an agent? Okay,
yeah,
okay, that's one. Very good. Okay, one. So let me just tell you, this is called the DAPE condition, DAPE. That agent that you mentioned, it is usually referred as DAPE. DAPE means dependent agent, and PE means permanent establishment.
an
DAPE,
establishment agent.
yeah, DAPE, dependent agent permanent establishment. This is one type of permanent establishment. Okay, there are other types of permanent establishment, by the way.
Hmm.
This was only one category, an agent who's operating on behalf of the non-resident person. That's one category of permanent establishment. So, by answer, you gave me one answer. Any other thing you can think of?
At the
What if they
moment, I
don't?
have only these two. Yeah,
What if they don't have an agent? Can they still have a taxable presence in UAE? Amazon,
yeah.
right? Amazon, Noon.
That's what the second point clearly states that any UAE sourced income,
Okay, so that means the state sourced income, the word state sourced income is slightly different from
the
the
permanent establishment,
permanent. Spiritual meaning is very different, is it?
fixed place of business. Yeah,
Yes, you are absolutely right. Their spirit, the meaning of their these two different ex expressions, there is a fundamental difference. In
yeah.
case of the permanent establishment, there will always be some sort of a physical presence usually, or at least there will be a nexus. We'll talk about the nexus rules later. But usually in permanent establishment, either there will be an agent, as you rightly said so, or they would take a trade license here. They would
Mm-hmm.
open a branch here, most probably,
Mm-hmm.
or they would have a fixed place of business here. That will become the permanent establishment. Okay,
Mm-hmm.
so these are different types of permanent establishment can take. In case of state sourced income, they will not have a permanent establishment. This is a the key point for us to remember. Whenever somebody asks you, na, tomorrow a layman asks you, I'm really confused with permanent establishment and state sourced income. Can you tell me something which will act like a flash of light and immediately clear the difference between these two concepts? So your answer should be, look, it's very easy. You can define the state source income in terms of permanent establishment also. Huh? What does that mean? I don't understand. So the answer is that, state source income is that taxable presence in any country in a scenario where the non-resident permanent person does not have a permanent establishment and still earning income from that country. That is the concept of state source income. Make sense?
A person who does not have a permanent place of business in
Yes.
the state but still earns an income from that
Yes.
state.
Yes. That is the state source income or geographically sourced income. Make sense?
Yeah.
Now, some of the very funny examples. Do you know the most expensive, the biggest concerts that have taken place on the face of the earth
Yeah.
historically in the history of mankind? They were usually from Taylor Swift, more than $1 billion in one night,
Mm-hmm.
right? Now imagine Taylor Swift concert happening in UAE one night. Okay, that lady flies all the way from US for one night only. Yeah, she holds a concert, earns $1 billion, and flies back. Does she have a branch in UAE? No. Does she have a trade license in UAE? No. She was a guest. She was invited by some event management company or something.
But the revenue was earned from the state, so she will be taxed.
Exactly. That is a classical example of a state source income. No permanent establishment, no nothing. Just temporary. Same thing goes with the FIFA World Cup that is happening right now in USA. Those teams from the so many countries of the world, they don't have a permanent establishment in USA. They don't have branches and all that. They're just visiting for a tournament. So like that. Okay, artists, players, whatever it is. So that was the concept of this was introduction only. Now Nexus is relatively newer concept. It has been there since ever, but it got evolved over the last probably a few years, maybe within these last 2 decades or so. The concept of Nexus, actually less than this time even, the concept of Nexus has evolved. We're going to see that the literal meaning of the word Nexus is connection or series. Okay. So, Globe rules and Pillar 1 has also highlighted, and there are actually Nexus rules, detailed Nexus rules that have emerged. And in easy word, in layman terms, okay, we can't use the word layman when we are studying tax because, but anyways, let's say a relatively newer guy, tax newbie, let's say, who wants to understand the concept of Nexus. The Nexus also may have more than one interpretation. One category we're going to see later on is called economic nexus, and that is now being widely acknowledged by OECD. So nexus rules that the latest nexus rules that have come in, if a non-resident person is constantly earning income from another country and the revenue level has reached a high level, let's say $100,000 or something, just for an arbitrary figure, which is it may be considered as a nexus, although he doesn't have a branch there, doesn't have a trade license, but he's still earning income, right? The fact that his revenue has exceeded a certain materiality threshold is it would become an evidence that the person has an economic nexus in that state. So he has enough customers over there, customer base, that now we can think of it as a permanent establishment of that person. Do you get this point? Does it make sense to you what I'm saying?
No, I didn't understand this part. Can you explain again, please?
Imagine you have a company who sells various merchandise, gifts, let's say. You are based out of India. You have a company in India. Okay, you're living in India also. You're a
Mm-hmm.
purely Indian company,
Uh-huh.
but you're selling merchandise on Amazon UAE, sitting in
Mm-hmm.
India. Okay, so would that, I mean, that would become a state sourced income, correct? Because it is still
Mm-hmm.
UAE sourced, right?
Mm-hmm.
Will you be subject to tax in UAE? That's the big question, million dollar question mark right now. You're a non-resident person. You don't have a permanent establishment branch. You don't have
Mm-hmm.
a dependent agent here, but you're earning certain income from Amazon. Will you be even required to register right now in UAE for with Federal Tax Authority? Latest information is that the last decision that came 2 years back was that non-resident persons who do not have a permanent establishment in UAE, they are not even required to register. Are you aware of that?
Yes.
There's a decision that came, right? So, which is actually this decision is in conflict with the decree law, by the way, just to let you know. Decree law says that the state source income is taxable. Okay, so it is a kind of a relief that has been given, basically. Okay, to non-resident person, they don't have to register right now. If they don't register, how they will file the return and all that? So how they will pay the tax? Nothing. They just go scot-free. But from an international law perspective, if your company which is there in India, they start gaining like really good traction in UAE, start earning, let's say, 1 million dirhams, right? Don't you think now this is something beyond? I mean, this has gone beyond. Like today it is 1 million. Tomorrow you start earning 10 million dirhams only from Amazon.
Mm-hmm.
Now, this is huge, right? So many companies are not earning 10 million dirham of revenue in UAE. But your company sitting in India is like really rocking the market by earning 10 million dirham revenue only from Amazon on noon. This is an indication that a nexus exists in UAE. Why? Because the size of your revenue has gone beyond, insignificance.
So Nexus has some threshold.
Yes, so exactly. So usually there would, if the country has grown a bit more matured in those respect in that respect, they will even consider giving a nexus to that revenue level or threshold. By the way, for your information, in the VAT law, there is a nexus, economic nexus concept already being applied between implementing states for non-resident persons. Have have you heard about this? If a non-resident person sells something to another implementing state and his revenue, touches the registration threshold of 375K, then that non-resident person has to register in that other country for VAT purposes. Are you aware of this rule?
But that only in the case of the books, not in case of the reality perspectives. So you do not register, by the way, if your threshold exceed 375.
No, hold on. I don't understand what you have just said. Or what
If
I
the
just.
revenue ex if the revenue exceed more than 375, supplying to the implementing state is not necessary that you have to register. That's only in the case of books, not in terms of reality, which means only for the exam purposes.
So yeah, okay, okay. So what you're saying is that people do not follow the law usually. That's what you're saying.
Which
In
means
in
the
in
yes, I'm not saying
reality,
people do not follow. I'm saying that's only for the case. And what do I say? Like, it's only for the exam purposes. You do not follow in the reality. In real life, there is no such rules to be really followed.
no, there are. You haven't read the VAT law on this?
But if I'm not wrong, if you're supplying from here to Saudi,
Yeah.
is going to treat it as the implementing state or it's going to be export?
That's so Saudi Arabia. Is this
Mm-hmm.
part of GCC, Gulf Cooperation Council? It is.
Yes.
Did they
So,
sign the VAT framework, common VAT framework agreement? All the states of the GCC? Yes, they did. It was
uh,
already addressed in the GCC
so you
framework
treat it
agreement.
an exporter, it's going to be implementing state
No,
rules.
brother, that's what I'm trying to tell you, that there is no one answer to this question. Right now in the governing law, it has two different scenarios right now. The seller from UAE, well, we have gone into VAT law for the discussion purposes, but I'm telling you because we can discuss this later after in this call in detail, but I will quickly answer you that if it is goods, I'm not talking about services, if it is goods, then there are two different scenarios. The seller will, it will be seen whether the buyer in the other implementing state, and I'm using the word implementing state, whether the buyer is registered for tax or not. If the buyer is registered for tax, then this sales transaction will be taxed in the country of the buyer. For the seller, it will be an out of scope transaction. The UAE seller is not going to raise a tax invoice. This will not be considered as an export.
Okay.
He will raise only a commercial invoice. The buyer in the Saudi Arabia, because he is registered for VAT purposes, that person is going to raise is going to book an RCM, reverse charge mechanism, because he
That's
can
okay.
book
That's
that,
it. Yeah,
right?
that's the same for us as well. When you import, you're going to do an RCM, by the way.
Correct, yes, but is this the same scenario that you will do for China or India, sales to China or India? No. When you sell to China or India, it doesn't matter whether buyer is, registered for tax or not. We will not consider this distinction. We will simply record it as an export, zero rated export. That's it. We're not going
Okay,
to.
so if you're doing to an implementing state, what do you do then? Like
See,
you, what is?
that's the million dollar question that we should ask, and that's what I just answered to you. If we are selling to an implementing state, we are going to ask the buyer, formally we're going to inquire the buyer, please provide us your VAT registration state. Are you registered for VAT or not? If the person says I am registered for VAT, then we are going to raise an invoice which will be a simple commercial invoice, not a tax invoice. Do you understand what I just explained? And alternatively, the guy says, no, I am not registered for VAT. Then what are we going to do? We are going to raise a standard rated invoice. It will not be a zero rated invoice. We are going to charge VAT with that person, or even though that guy is living in Saudi Arabia. This is the uniqueness of the intra GCC sales in implementing states. You should study the VAT law on these aspects. And after the call, if you want more discussion, we can do that. But the whole discussion that I raised here was that the tax registration rules in VAT are also slightly interesting and different. And in those rules, if the nexus has been hit, if the sales have already reached $100,000 in the implementing state, then the person is required to register for VAT in that other implementing state. We can see that. We don't have to argue about it right now. We can address park it and we can discuss it after the call itself, because that has to do with that. But I was trying to make a point here that Nexus does have impact. Okay, and a very interesting point. One additional knowledge I am going to tell you about, that in Zatka in Saudi Arabia, a very interesting registration angle has been provided, and that says permanent establishment without the mention of the word branch or anything for the corporate tax purposes. The same scenario you might find in certain other countries of the world as well, which means that they acknowledge that sometimes permanent establishment goes beyond the concept of only a branch, right? So they give that status as a
Hmm.
permanent establishment. So anyways, do you want to discuss more on what we have discussed on the non-resident side, or shall we move on?
Yeah, we can proceed.
Okay, UAE branches of resident persons are treated as the same taxable person. Uh, just hold on one second. Hello, sorry, there was a temporary interruption. Okay, so what were we talking about? UAE branches of resident persons are treated as the same taxable person. Yeah, so now, this was something I already said before. So there can be branches of a UAE company, but we don't have to worry about them. They'll be considered as part of the same resident person. Cabinet will define which businesses by natural persons are subject to corporate tax. So there's a cabinet decision on this particular topic. Which income is subject to UAE corporate tax? Okay, that's a topic of discussion. The irresident juridical person is taxed on taxable income from both UAE on and foreign sources. So if you really think about it, this is the worldwide income. Don't you think so?
Yeah.
Resident juridical person, worldwide income. A resident natural person taxed on income from UAE. And yes, abroad as well, but only if it relates to the business or business activity carried out in UAE. So basically exports, if you really think about it, because export will happen from UAE. So it is still a UAE income. So this is how the resident juridical and natural persons are taxed. What about the non-resident person? A non-resident person is taxed on income from the permanent establishment in UAE. Non-resident person, we saw that, right? Three things we discussed: permanent establishment, state source, and nexus. But this nexus is actually an extension of permanent establishment. It's a new dimension of the permanent establishment. So non-resident person, either it will be either permanent establishment or state source income which is not linked to a permanent establishment. And the third category, which is being highlighted separately, is that income linked to a nexus, as we discussed earlier. Now, the funny part is that right now in UAE, the definition or concept of nexus for the corporate tax is very limited. So we are safe. We don't have to, go into complications. Right now, the concept of nexus in UAE is very limited. We're going to see that soon. Okay, we're going to see what this word nexus means for the purposes of UAE corporate tax right now. It may change in future. So first point, what is permanent establishment? So natural person is considered to have a UAE permanent establishment if how many categories we discussed? You mentioned very rightly what was that? Dependent agent. They have a fixed or permanent place. That's the first and predominant category of permanent establishment. Fixed or permanent place of business. Second, a person habitually exercise authority and control whatever. This is called that dependent agent PE, right? And the third thing is the nexus. So as if you recall, that's what I've been saying, that actually nexus is one type of permanent establishment, and this has been addressed in the relevant article in the UAE decree law itself. I think Article 14 is for permanent establishment. So the nexus has also been made part of the concept of permanent establishment. Three things. Okay, three things. Fixed place of fixed place PE, dependent agent PE, and then nexus PE. Let's have a look at this. The first category, which is the fixed place of business PE. There are different examples. By the way, if you look at the same document which I opened a little while ago, Model Tax Convention, when you read the discussion on permanent establishment in the Model Tax Convention document, you will be surprised to see that this is the ditto copy of that. It has been taken in its entirety almost from Model Tax Convention. Okay. Examples of fixed. Hello, are you there? Are you listening?
Yeah, I'm
Yeah,
there, I'm
okay.
there.
Examples of fixed or permanent place that qualifies as a PE are that can be management place for decision making, Branch, office, factory, workshop, land or real estate, installations for resource exploration, the oil wells, etc. Mines,
Which can
oil,
determine P, right?
yeah, sorry,
These are the lists which will determine PE, correct?
correct. Yeah, these are the examples basically. Construction, assembly, etc. as well. But a place will not qualify is as PE or ancillary business basically. If you really want to summarize all of these are auxiliary or ancillary businesses which does not really evidence that the proper business is being conducted.
It has some
Storing
percentage of this, no?
percentage? No.
Yeah, I'm asking auxiliary business,
No,
like what if in case
no,
somebody
no,
there?
no, 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 no. There is no percentage highlighted. It is a
Okay,
very subject to, how do you say, case to case basis,
okay,
depending on
okay.
the significance. You're going to see the third part right now. But first, let us finish the second part.
No, for
The
the
except.
constructions, no, the question I asked you because there is a list which says that it will form a PE if you're going to do construction, assembling, or installation. In that particular activity, if there is anything they do, which also sorting and all this will not be calculated for that particular revenue for determining PE is the question.
Uh, please repeat your question so that I may understand exactly for what you're saying. I can't understand right now.
The last point
This
on
one,
determining a
construction, assembly,
PE,
etc. Okay.
yeah, exactly. If that particular activity forms a PE
Okay.
and
It's in the
they,
last 6 months. Okay.
yeah, yeah, they also do some ancillary, whatever the list which is mentioned at the
This one.
below.
Okay.
Yeah.
Okay. So, what are you
And
saying that is there a de minimis threshold like this much
I'm
amount
not
of
asking de minimis. So what happens? It's completely to be removed.
no, okay, I'll explain. Okay, okay. First thing is these this line is one of the examples of a permanent establishment because there is a concept of SIGA. Have you heard SIGA? Core income generating
Yes,
activities,
yes, yes,
right?
yes, yes.
So this these are basically construction. So this can be a SIGA activity, right? These are usually they are not SIGA for certain, from unless it is a logistics company that then it will be different because they'll be earning revenue for it. These are ancillary and auxiliary activities. There is no percentage involved. Why? Because these in majority cases they are not even revenue generating activities. These are back office costs or these are cost centers only, like a
Mhm.
storage or display. This is not a revenue earning activity. It's a back end activity actually. Holding
What if it
stock,
is both? Yeah.
it can be, yes. If it is
So
both,
then,
yeah, yeah, no, hold on, a very good question. If it is both, then it becomes easier. It is an income generating activity, my dear. Then this is not even, you know,
you separate that. That's the question.
that's no, no. It becomes it becomes an income activity. Then there is no question that is left. Then the company is actually earning income. It will automatically move here. It will no
But
longer
this is not a
remain.
code. Yeah, that's what the question is. That the other part is not a code generating. The first one is a code generating income. So I take that as a permanent establishment. Whatever revenue is generated, it's going to be under that.
So there, just to clarify, there it's think of it as other income, right?
Mm-hmm.
So even the places do not qualify for PE if it is solely used. Please understand this word. This is used for. So this is consumption, own use. This is not generating of income from this. If it is solely used for, this is internal use being referred here. Okay, own storage, own display, not earning income. If it is earning of the income, then it will be. It doesn't matter. It will not matter whether it is core income generating activity or otherwise.
The
What will
auxiliary
matter?
nature is what?
But boss, hear me out. First thing is that we need to divide this into income generating and other, or only cost center. Forget about the distinction between core and support. First point that we need to remember is whether this is an income generating activity are only a cost center. That's the $1 million point that we need to remember. If it is an income generating activity, even if it is not a core income of the company, what did I say? Even if it is not a core income generating activity of the company, it is an other income activity of the company, a smaller part of the revenue portfolio, but it is still happening through a fixed place of business. Boss, this will still be a permanent establishment. Do I make myself clear? And the entire document that we are going through, you will not find a percentage or threshold or
Not the
anything like that.
percentage, not the percentage. I didn't mean the percentage. First, it is a supporting activity that you said. Okay, it is not a generating income.
Hmm.
Second, the topic of the line it says that the place does not qualify as a PE if it is used
Hmm.
solely for the purpose of not generating income, correct? Then you
Correct.
see point number one, sorting, displaying, and delivering
Yes.
goods, and the
Yes.
last point which says performing activities of the preparatory or auxiliary nature.
Yes, correct. So thank you very much for saying this. This is exactly what it is. You rightly pointed out finally that we are not talking about income generating activities here. If that point is clear, now rest is it all becomes easy to comprehend. If it is not an income generating activity, then purely from an accounting perspective, what will it be? It will be a cost center, correct? Yeah. So all of these are basically cost centers. And by having only these things, taxable presence of the company is not evidenced. If we are good until these 2 points, then the interesting thing is going to come in the next point. Are we good until these 2 points, first two
Okay.
examples? Because the third thing is very interesting. Do you know what this third thing is about? This is an exception to the exception. Second category was an exception, right? We said, first category, we said there has to be a fixed or permanent place, right? So it will become a permanent establishment, and we gave, various scenarios of that, right? Then we said no, but there are certain exceptions to the general rule of fixed place. These are also fixed places, by the way. These are fixed places, but these are exception to the general rule. Although these are fixed places, but they are not permanent. They will not be considered as permanent establishment because these are ancillary, auxiliary, activities. These are not income
Mm-hmm.
generating activities. This is an exception rule.
Mm-hmm.
But then another reverse exception rule comes in. Think of it in this way: rowing a boat in the river, it requires two things: boat as well as I don't know what you call them. The In Hindi, maybe chappu we call them. I don't know what we call it, but in English, but the blades maybe through which you row the boat, right? These are lying in two different places. Are you able to cross the river if you have only access to the boat, but not to access to the blade? You cannot,
Mm-hmm.
right? In order to cross the river, you need both the boat as well as the blades, right? So in their separate isolated capacity, the boat as well as the blade fall or land under this category, ancillary or auxiliary activities. But combine them and it will become exception to the exception. So what even preparatory or auxiliary activities will constitute a PE if the same or other place is used by a related party. The combined activities are no longer preparatory or auxiliary and form a cohesive business operation. Do you understand what I just illustrated through that boat example? Two different things, two different mechanisms are there, or two different places are there in a country, and if at the in their individual standalone capacity, they can't constitute permanent establishment, but if seen together, if they operate together, they can form a cohesive business operation. If that kind of a scenario exists, tax authority will have to be very clever in identifying this matter. so that they can tax that non-resident person. Otherwise, the people who do this tax avoidance, the non-resident, they are extremely clever. They get away with creating these type of traps, and they get away with not paying tax in the other country. Is this point clear? Shall we go to the next?
Yeah, yeah.
Dependent agent permanent establishment. So, date. A person is considered to habitually act on behalf of a non-resident person, thus creating a PE if they habitually conclude contracts on behalf of non-resident person. That's the first point. They conclude contracts. That's first point. Negotiate contracts which are then accepted without significant change by the non-resident person. In 2021, beginning 2021, I was in Oman on behalf of a local firm of UAE. Okay, we did not have a legal entity established in Oman at that time. I was the managing partner for that company in Oman. Okay, Oman operations. So whatever I concluded with a client, it usually without any changes, actually 99.9% of time, it was accepted, it held. That became our formal contract. So habitually conclude contract, I am the managing partner, I am doing everything on behalf of the non-resident person. First condition met? Yes.
Mm.
Habitually conclude contract. Second condition, I negotiated with the client, and whatever I decided, it was accepted without significant change by the head office in Dubai. Both conditions are met. What was I? I was a dependent agent permanent establishment for the Dubai company. Understood?
Right.
Without having any legal entity in Oman. Exception, the above does not apply if the person is an independent agent. So there can be another scenario. I am not dependent on that company in Dubai.
Yeah,
But
multiple works.
exactly. So that makes me an independent person. They are exclusively or almost exclusively for non-resident. That's the situation. Or exclusively or almost exclusively for non-resident person. That's the concept of dependent agent. They are not legally or economically independent. These things are there, then the person will no longer be an independent person. Okay. There are usually, just for information purposes, three different criteria that identify or signify dependency. For legal, uh, financial, and economic. Three different criteria.
They have
Okay.
the right to do it on the behalf of the company and become
Yes.
dependent.
Yeah. So if they
The
cannot
opposite, the
do,
other side.
yeah. Okay. Conditions of a temporary and exceptional presence in the state. Now, okay, the presence of a national person in the UAE, it shall be considered as a consequence of a temporary and exceptional situation. Why is this even there? Why this provision was brought into the UAE tax law?
Because like you might do an activity for some time.
Okay, and what will that ensue, or what will be the result of that?
That will form a PE, by the way.
Ah, so it was a PE risk. We call it as a risk, PE risk, permanent establishment risk. So
This happens most of the real estate or like constructions.
yeah, not yeah, it can, and actually, this thing became a lot more riskier in 2020 when COVID happened. You remember? People were what do you call quarantined. The entire airports were closed.
But they gave exception during that time, I believe.
That is exactly why this clause is here,
Hmm.
to address that situation. Shall be considered a consequence of a temporary and exceptional situation. That's why. Thank you for saying that. That is exactly why this law is there, where the following conditions are met. Presence of the natural person in the UAE is a consequence of exceptional circumstances of a public or private nature. It can be public nature, like the COVID or some uh, regional level conflict or unrest, whatever. And but it can be private nature as well because of your personal reasons. Certainly, you got seriously ill, hospitalized, whatever, right? So this can be a reason. The exceptional circumstances cannot reasonably be predicted by the natural person or the non-resident person. And it was a total surprise. Whatever happened, it was a surprise. Nobody knew that it will come to that. Third, another scenario, the natural person did not express any intention to remain in the UAE when the exceptional circumstances end. Yeah. I mean, okay, that's another very interesting angle. Okay, I'm stuck in UAE right now, but I don't really plan to be stuck in the UAE as soon as these circumstances are over. I will immediately go back. I have other stuff to do in my own home country, right? If that is the case, then yes, the tax authority will have a favorable view on the temporary presence. But if you say no, no, actually you're fine. I mean, now I'm thinking that I'm going to have my permanent, home here, and I'll go buy property, and I don't plan to leave UAE. Then that will be a different scenario. That will no longer be considered as a temporary circumstance or exceptional situation. Non-resident person does not have a permanent establishment in the state before the occurrence of the exceptional circumstances. Yeah, there shouldn't be any other, like you already had a branch here. So if you already had a branch, you're already a dependent. Sorry, you have a permanent establishment here. The non-resident person did not consider that the natural person is creating a permanent establishment or deriving income in the state as per the tax legislation applicable in other jurisdictions. Okay, non-resident person did not consider that the natural person is creating a permanent establishment or deriving income in the state. So that company did not know that their agent, for example, is deriving the income in the state as per the tax legislation applicable in the other jurisdiction. So, that's another. If a non-resident person's dependent agent is here in the UAE, and that in that non-resident person is not even aware that this guy is, what is it called in corporate in business law terms? It's called the law of estoppel. Have you heard about it? Estoppel or holding out.
No.
Sometimes a person can, uh, hold out on behalf of another party that kind of represent them without the knowledge of the other party. So in that situation, then the other party has to basically ratify it, ratification that, yeah, no, this guy who was representing us at that time, he was doing it, we accept that simply. So that's but in this particular case, I mean, if the non-resident person did not even know that, oh, this guy is our director and he was here in UAE, but while he was here, he was doing some business earning. And non-resident person did not know, and they were not even aware that this would, create a permanent establishment in UAE. So this is a very, I would say, it's a very facilitating provision. It kind of, if you really think about it, it conflicts with the previous harsh conditions. So this is basically a kind of trying to give a relief to the non-resident person. So uh, there was more discussion needed. Like, okay, what are the public nature circumstances? Right? Exceptional circumstances is a situation or event beyond natural person's control, occurred while the person was already in a state, could not be reasonably predicted or prevented. Or prevented the person from leaving the UAE against their original plans. So if these are the indicators, these are the litmus tests, then it will be considered as circumstances of public nature. Such circumstances include, but are not limited to, so many different examples. Adoption of public health measures, some outbreak or whatever. Travel restrictions were there. Legal sanctions were there on the natural person, preventing from leaving the state territory because of certain, violations maybe. Act of war happened, occurrence of terrorist attack, natural disaster, beyond, force majeure, any other circumstances which are beyond the control. any other similar circumstances. So all of these can be public nature. Now, private nature ones are relatively easier. Occurrence of an emergency health condition affecting the natural person, affecting their relatives up to fourth degree. You remember this fourth degree condition? Where is it repeated in
Yeah,
the definition of
yeah.
related parties?
Yeah, connect and related parties. Yeah.
Right, yeah. So in the related party, you will find this. By the way, this is also taken from the Model Tax Convention 2017, including by way of adoption, by way of guardianship, any other prescribed condition. All of that was, this was an indication of private nature circumstances, exceptional circumstances. Now, we come to another very interesting topic, which is not really covered in a lot of detail actually in the UAE. It is still, it has been kept light, let's put it that way, for the corporate tax purposes. Literally means connection or link between persons. Refers to taxable business presence of a person in a jurisdiction due to its sufficient connections in that jurisdiction. That is nexus. Is this point clear? Is there any confusion on the concept of nexus?
No, we can proceed.
Okay. Now, different types of nexus exist around the world. One is a physical nexus. It actually, if my memory serves me right, for the first time in 2018 or something, a US court decided on a sales tax law for the first time. The concept of nexus, where uh, one seller from one state in United States was subjected to tax in another state, just and that seller was not registered in that other state, but it was exceeding the prescribed threshold, and it was significant. So when the authorities tried to tax uh, that seller took the refuge, saying that no, it is not in line with the law. Law does not. Law says physical presence is needed. Physical registration or presence is needed. But then it went to the court, and court for the first time in the history, mostly around the world, said that no, there is enough economic connections of this seller with the state that we feel that he has a permanent presence in that state. That amounted to the nexus for the first time. You can search on Google. You'll find that case law. So physical nexus is the traditional rule. Uh, in old days, it was physical. So office, sometimes, this physical nexus, by the way, even today in UAE, this is the only category of nexus that is applicable in the UAE corporate tax. A building, you will find that. An office, warehouse, or store, employee says up inventory stored in a something. But in UAE, when you will see, you will find that the building is the only example of nexus that is applicable.
Mm-hmm.
So, example, a company based in Texas opens a branch in California, so nexus is established, must pay California taxes. Now, another category is economic nexus.
If
This is the
somebody owns a property in UAE
Mhm.
and do not have any official residency status here, that becomes the nexus, right?
That becomes a nexus. That's the only category of nexus available in UAE corporate tax law. Okay. Other nexuses have not been, this economic nexus, for example, it is still not hit right now in UAE. Economic nexus, modern rule. This is a case actually. So even without a physical presence, business may owe taxes if it meets certain economic activity thresholds, such as sales revenue exceeding a set limit or transaction
So there
volume.
is no threshold for UAE in specific.
No, no. This whole economic nexus right now does not exist in UAE.
According to UAE corporate tax law, only the building will form nexus. That's it.
Only the building is will form the nexus in UAE. We don't want to call it economic nexus. It's only
Okay.
simply one word, nexus. Okay. There is another example, it's called click-through nexus or affiliate nexus. If a business pays commission to in-state affiliates like bloggers, influencers who refer customers, This is also an example of a nexus. We
Even in
still
this
have,
case, UAE does not tax.
no, they don't. Yeah, it's still not. Who knows? Maybe in the future too much changes are going to.
As of now, I'm talking
As
about
of
it
now,
does not
nothing.
form an excess.
As of now, no, no. Marketplace nexus. This is Amazon, Etsy. This is also one example of nexus. We have been discussing it, right? Amazon and Noon example that we gave earlier on. That also doesn't exist in UAE right now. Okay, and
But
if that
okay, this is
marketplace,
is absolutely opposite, right? In terms of this, like, for VAT, that you have to register, correct?
yeah, for VAT you have
Have to
to
register.
register. Yes, absolutely. Non-resident supplying goods, yes, they have to register. Okay, so non-resident persons nexus in the state. Non-resident persons nexus in the state. General rule of nexus: any juridical non-resident person shall have a nexus in the state if it earns income from any immovable property in the state. That's the Article 11 of the Federal Decree Law number 47. Article 11. So if it earns income from immovable property, that's what we discussed, right? Nexus
Well,
from
yes.
exploitation of immovable property, the Cabinet Decision number 35 of 2025. Non-resident juridical persons nexus from immovable property is subject to the following conditions. It derives income from any immovable property in the state from the right in rem, sale, disposal. All of this is basically real estate related income. Rem, sale, disposal, right assignment, direct use, letting or subletting, etc. Right? Any other form. All of that is income from immovable property located in UAE. Okay.
Mm, okay.
Now we have some other things as well. There is another type of nexus which is from qualifying investment fund. We have to read it carefully. Non-resident juridical persons taxable income from Nexus by way of investment in a qualifying investment fund. Now, there's a non-resident person sitting somewhere in India and they have invested in a qualifying investment fund. Is determined as follows.
Qualifying investment fund is basically the other day what we spoke, listed in the stock market and stuff, right?
Yes, yeah, conditions are there. It's an
Okay.
investment fund properly regulated. They're investing in securities which are traded on a
Publicly available.
recognized stock exchange, etc. Recognized stock exchange will come into play here. Article 2.2 of the Cabinet Decision number 32 of 2025 and Article 3.2 of the Cabinet Decision number 34 of 2000. Two different Cabinet decisions are there. It is determined as follows. Taxable income for a tax period of a juridical person that is an investor in a qualifying investment fund other than a real estate investment trust. Rights are excluded, shall be adjusted to include the prorated net profit in the following cases. Scenarios are provided later. These are the scenarios where the qualifying investment fund has less than 10 investors. In that entire fund, only less than 10 investors are there. And the investor and its related parties own 30% or more of the ownership interest in the qualifying investment fund. So there's a power group. That investor and the related parties own 30% or more, at least 30% in the ownership interest in the qualifying investment fund, or have the ability to conduct any of the following. Power play, exercise 30% or more of the voting right, determine the board of directors, 30% or more of the board, receive 30% or more of the profits. All of these are evidences of control, right? If you remember certain,
Mhm.
so if there is but the threshold that has been provided is only 30%. And here, this is in addition to that 10 investor rule, has less than
But
10
qualifying
investors.
investment fund, if my memory serves me right, the other day we saw it should it shouldn't be more than 30%, but here it says it should be more than 30%. Or maybe I'm confused.
What is,
In qualifying investment fund, a fund should not con something related to. Okay, anyways, I'll refer to that later.
yeah, yeah, later on we can discuss that. Ask me if you have any confusion later on, we
So
can.
this point which says like, 30% is what it exactly says. It says 30%.
The investor and its related parties own 30% or more of the ownership interest in the qualifying investment fund. Okay. The question is what is the meaning of the word ownership interest, correct?
Mm-hmm.
That's what we need to understand. Let's see if I have written it here. If not, I will open this. No problem at all. So this is basically cabinet decision number 35 and cabinet decision number 34. Okay, let me open these two decisions. Let's see. Okay. Okay, leave it. I will just use my other way. Cabinet decision. Yeah, there you go. 34 and both we got. Very good. Okay. So, what was the question that we had? Ownership interest, right? There you go. Rights and interests of any kind directly held by the investor in a qualifying investment fund, a real estate investment trust, or a qualifying limited partnership. So these are the ownership interests, basically rights and interests in any kind of of any kind directly held by the investor in a qualifying investment fund. This is the concept of ownership. Why does an investor come to an investment fund, qualifying investment fund, to invest money and get interest or profits on it, right? So
Mm-hmm.
that's the ownership interest. Right? Mutual funds, for example. Sir, we are going to issue you these many units from our investment fund. That's the ownership interest. Okay.
Yeah.
So, right. So now, so basically, what is it? What are they trying to say? As I said earlier, na, power play. So if that investor is effectively controlling or significantly influencing that investment fund, how can he do that? If that investor and the related parties own 30% or more. So maybe a
Mm-hmm.
spouse, maybe fourth degree relative, right? And they all together they own, at least 30% of the portfolio. Then they are controlling, they're or at least significantly influencing the investment fund, right? So why were we even discussing all of this scenario? The So that we non-resident juridical person's taxable income from Nexus by way of investment in qualifying investment fund is determined as follows. Taxable income for a tax period of a juridical person that is an investor in the qualifying fund other than right shall be adjusted.
I
Taxable
think
income shall be adjusted to include prorated net profit in the following case. Yes.
I think qualifying investment fund as 30%, REIT as different. I think it was, I just got confused with the REIT because REIT has some persons to hold, right?
Hmm.
Real estate investment fund. So that's the
Correct.
confusion. All right, I
Okay.
got it now. All right.
Okay. Okay. Fourth criteria of the control was determine or exercise significant influence over the conduct of the business and affairs of the qualifying investment fund. So if that happens, then the prorated, income from that fund will be included in the taxable income of the investor. Where the qualifying investment fund has now the previous all discussion was 10. How many was it? Has less than 10. What if there is more than 10, has 10 or more, at least 10? The provisions of the paragraph A will apply, that the ones that we read just now, provided that 30% is replaced by 50%. Everything stays the same, but instead of 30%, it becomes 50%. Why? Because here the number of investors has increased. Previously, it
Mm.
was a smaller play. Here, it is big play. And the bigger play means that the level of control should also be higher. 50% or more should be controlled by one party with its one investor with its related parties together with its, then such income shall be included in the taxable income of the investor, non-resident juridical person. So whatever income we earn, that will be included in the taxable income of that investor. Okay. Shall be adjusted to include the net profit, basically. So this, even the word, don't be confused by the word prorated. It's simple, net profit included, to include the prorated net profit in the following cases. Basically, what we are saying is that qualifying investment fund will have a profit and loss account, income statement, whatever it is, right? And whatever the bottom line profit, that there will be a percentage of that profit that will go to that investor, right? Because the investor has ownership interest in that qualifying investment fund, right? Let's say 30%, as we saw here, right? So 30% of the profit that investor is going to include in their taxable income. But don't you think this is a unique situation? This qualifying investment fund, then it becomes tax transparent. Don't you think so? If the income is being taxed in the hands of the investor, don't you think this is a tax transparent entity then? Have you heard about tax transparent entities?
No.
Flow through entity, tax transparent. Have you heard about unincorporated partnerships?
Unincorporated partnerships. Yeah, yeah. This is also same, right? Flow through.
Yeah. So I
Uh,
just want you to remember this flow through entity. Uh,
yeah.
uh, 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 Very formally used terminology by the BEPS Pillar 2 is tax transparent entity.
Mm.
Okay, tax transparent entity, a flow through entity, yes, but even a clearer expression is tax transparent entity. So this tax transparent entity basically is that entity which is not taxed at entity level, but the income of it goes into the hands of the a taxable person or the
Main
shareholder,
main
etc.
end.
Yeah, and it is taxed in their hands. Okay, so this was qualifying investment fund. So, qualifying investment fund with more than 10% immovable property percentage. So what if that qualifying investment fund is also earning income from immovable property? Where a qualifying investment fund, other than a real estate investment trust, has an immovable property percentage above 10% of its total investment in its financial year. The taxable income for the tax period of a non-resident juridical person investor shall be adjusted to include 80% of the prorated immovable property income. So not the 100%, but only 80% of the immovable property related income. The taxable income for the tax period of a non-resident juridical person investor shall be adjusted to include 80% of the prorated immovable property income. Does this make sense? There is a relief of 20%. It is being kept out of the tax net.
Mhm.
Share of income from exempt real estate investment trust. The taxable income for a tax period of a foreign juridical person. Taxable income for a tax period of a foreign juridical person that is an investor in a real estate investment trust that is exempt as a qualifying investment fund shall adjust to include 80% of the prorated immovable property income. Now that's a very interesting angle. Taxable income for a tax period of a foreign juridical person that is an investor in real estate investment trust, which is already exempt as a qualifying investment trust. So it's a tax transparent entity basically. Entity is exempt, so income is taxable in the hands. Again, it shall be adjusted to include 80% of the immovable property income. Effectively, like kind of similar repetition. Such investor, so there is a 20% relief provided for the immovable property income. It will not be included. It will not be taxed. Such investor may adjust its taxable income to include depreciation adjustments for the immovable property. So that investor may adjust the taxable income to include depreciation adjustments for the immovable property. So yeah, I mean, uh, the depreciation adjustments for immovable property, if I remember correctly, there's an MD, Ministerial Decision number 134, I think. In which the detailed adjustments have been addressed and highlighted. And probably that decision even addresses uh, investment property related matters as well. So even there are depreciation adjustments identified for investment property model that allows for the depreciation, and that is being referred here. So if there is allowable adjustments for depreciation related to that investment property, tax law will allow to make those adjustments. Now, the trigger point of when the income will be taxed, date of creation of Nexus by way of investment in a qualifying investment fund. So this is a triggering event. Nexus in the state shall be created as of the date in case the fund distributes dividends within specified time. So triggering event is distribution of dividends. The date on which dividends are distributed by the investment fund. Okay, the date that the dividends are distributed, that distributes 80% or more of the immovable property income. Now that's huge. It's not so. What is the key consideration here? If a fund is distributing this much amount of dividends, so there's it really removes the risk. So whenever a fund or even a taxpayer, in those countries where even dividends are subject to taxation, when they actually distribute it, tax authorities take a flexible, favorable stand, viewpoint towards it. So they see it favorably. They say, okay, now we will be kind to them, basically. You understand what I'm saying? So the date on which the dividends are distributed by the investment fund, that distributes 80% or more of the immovable property income. So immediately the authority becomes a bit relaxed or more favorable. Within 9 months from the end of such a fund's financial year. Now, this 9-month duration is actually, if you really think about it, it is aligned with the tax return filing deadline. So, if the if the fund distributes 80% or more of the immovable property related income within 9 months, then the date of the dividend distribution will be the date that the nexus will be seen as formed. Nexus will be considered. In other cases, the date of acquiring an ownership interest in an investment fund. So in other cases, it will be the date of acquiring an ownership interest in an investment fund that does not distribute such a percentage within the aforementioned timeline. So if you really think about it, those they are being treated a bit strictly if you really think about it. Here, the nexus is being formed at the last moment when that income is being distributed. But what about this situation? If they did not distribute it, then the date of acquisition of ownership interest That will be the date of formation of Nexus of that non-resident person. We need to remember one very important point. What did we just study? The entire discussion that we did about the qualifying investment fund. Can you summarize or repeat it and tell me the key point? Why did we discuss this? Why did the mention of Nexus came into the entire discussion? Hello? Hello?
Hello? Yes,
Yeah,
sir.
yeah. My
Yeah.
question is, we have been
Sorry.
discussing, we've been reading
Mm-hmm.
qualifying investment fund, right?
Mm-hmm.
But is it only qualifying investment fund that we were reading, or we were reading something else?
This is related to the Nexus, right?
Nexus. What we were studying was actually Nexus.
Yeah.
Why
Nexus in
Nexus?
specific about the
Hmm.
about the uh the
What is
Nexus
this?
rules.
What is this
Yeah.
chapter that we are studying? Entire chapter that we are studying. Residency and source, right? We are
Mm-hmm.
studying the concept of residency and source. And after studying the resident person, we had come to non-resident person. How is non-resident person taxed? That's what we were studying. In the non-resident person, we addressed the first point as permanent establishment. We discussed that.
Mm-hmm.
Then came the point of
Dependent
next
agent.
dependent agent. We also discussed the dependent agent part. That was still permanent establishment.
Mm-hmm.
And then came the point of nexus, the discussions
Nexus.
on the nexus.
Mm-hmm.
That was another angle of bringing the non-resident persons into the tax net of UAE, right?
Correct.
So
That becomes the globe.
when we reach that point, then
Mm-hmm.
since we were studying about the nexus of a non-resident person
Around the globe. Yeah.
in the UAE, why are we taxing that non-resident person in UAE under UAE corporate tax law? Why are we doing that? That person did not do us anyhow. He's sitting in India. Why are we taxing him here in UAE through qualifying investment fund? Is it his fault that he paid money into UAE? He was kind enough to invest into UAE. So what we are doing is we are saying that look, we will give you certain benefits. We will remove 20%, if you have in what is that? Hello?
Yes.
You, I think you clicked the WhatsApp call. But anyways,
Me?
uh, yeah, I was receiving a WhatsApp call from your mobile number. So
My
anyways,
phone is not even next to me.
okay, no worries. What were we talking about? Yeah. So what I was saying was that this is taxation of the non-resident person based on the nexus concept, based on the nexus that they have in UAE, just like a permanent establishment. Okay.
Mm-hmm.
So that's why we were studying all of that. So what will happen with that non-resident person? Will that person be required to file a return of income, corporate tax return in UAE?
No.
Huh? No. Why? Boss,
I
if
mean,
if they will not be required to file a return, then why are all these provisions coming in? Such investor may adjust taxable income to include depreciation
I,
adjustment. It shall be adjusted to 80% from the move. Why all of this pain of issuing all these
they're only
decisions?
meeting the conditions, right?
Yeah, but they are meeting the condition. Yeah, shall be adjusted to include
What
80%.
if in case they don't meet the condition?
No, my simple question is that is this taxable income from UAE corporate tax perspective or
Yeah,
not?
provided they fall under categories, yeah, of course, yes,
Yes,
100% they
so
have.
they will have
Because
to
I was thinking the
register.
other way around. What if in case they don't meet the conditions, if everything is not met, so they don't have to file, right?
No, this is they will if it is not met, then they will not get the benefit of this 20% exemption. You see, in our rules that we have read, they are getting the benefit of 20% exemption. They are only including 80%. They will not get that benefit if they don't meet these conditions. They will have to
That's 20,
pay
that's 20% exemption benefit is for the total income that is being generated under the qualifying investment fund.
Now it shall be adjusted to include 80% of the prorated immovable property income. That 20% benefit is for immovable property income. The rest of it is, the other stuff. Rest of it is various other stuff. So prorated we started from here, Nexus from qualifying investment fund, right? That's where we saw that there were different scenarios identified. Less than 10 investors. So they will have to include prorated net profit in their investment, in their tax return, in their taxable income. These conditions have to be met. They have to be, own or control 30% of the ownership criteria. Only then they will, include prorated net profit. Then such income shall be included in the taxable income of the investor, non-resident juridical person. But
And
uh, yeah.
at 30% on the qualifying investment fund, if it is less than 30%, then it is not taxed.
Uh, let's have a look at it. Investor and
Yeah.
related party own 30% or more,
Hmm.
then it will be included. I think there is there is one point missing in here, because there's a mention of a prorated. Let us have a look at it. This is that 34 cabinet decision number 34. So if you look at the percentages that are provided, uh, conditions to exempt a qualifying investment fund from corporate tax. So this is the exemption of the qualifying investment fund directly. But this was another article that we were looking at. I think it was Article 4. Uh, yeah, I mean, what we are looking at is different conditions of exemption uh, from corporate tax. Let me look at the article precisely, and then we're going to read that particular article itself. Hold on a second. 3, yes, Article 3. Yeah. Now let's look at the Article 3. Investor income from a qualifying investment. The taxable income of a taxable person that is an investor in the qualified investment that is exempt from corporate tax shall be adjusted to exclude any profit distributions received from the qualifying investment fund. This is the first point. What do you
Okay.
make up? Yeah.
Just to rephrase it, we are looking to this points for a nexus to invest on a qualifying investment fund in UAE, correct?
Yeah, these are the Nexus rules, correct. And this
For
entire
UAE.
decision. Yeah, yeah, for UAE. This is UAE. Have a look
Ah,
at the
okay.
name.
Okay.
This is a decision on the qualifying investment funds and qualifying limited partnerships for the purpose of federal decree law. And let us have a uh, see this conditions to exempt qualifying investment fund from corporate
Yes.
tax.
Because the initial point for the nexus was set that nexus is only for the real estate, right? For the buildings, correct?
Yeah, in UAE, actually, when I said we have only one type of nexus, it is not the case. It is not the case because this decision came a bit late, and this is a decision of 2025. So in 2025, this uh, concept of nexus emerging from qualifying investment fund was introduced for the first time. So for a long time, since 2022 actually, until 2025, the nexus existed as only one thing, immovable property. In 25, for the first time, the concept of Nexus was expanded to include the investment fund as well. Okay, and
Qualifying investment fund.
qualifying investment fund, yes. And and what and you know a lot of definitions have been provided. We can look at the definitions because this is going to be a very detailed topic. But if you have, we're going to go through this to get a clear understanding. Shall we move through it in a bit more detail?
Yeah, please proceed.
Okay. So first thing, what is an investment business? The business or business activities of using an investment interest to raise fund. That's the investment business to begin with, right? Uh, Immovable property means any area of the land over which rights have or rights or interests or services can be created. Building, structure, engineering work, fixtures, etc. All of that is immovable property. Now, immovable property income, net realized profits derived from the right in rem, sale, etc. So basically sources of real estate. These are all right in rem, sale, disposal, etc., etc., etc. These are all the types of income that people or companies earn from immovable property. In this, and these we're talking about immovable properties that are located in the state as recorded in the financial statements. The qualify for the qualifying investment fund for the real estate investment trust, as the case may be. Let us read the rest of the sentence as well. Including subletting and other forms of exploitation of the movable property which is located in the state as recorded in the financial statements and in proportion to the investor's ownership interest, how much amount the investor has invested in that fund, and after excluding the income attributable to the investment manager. Now, this is the compensation that is awarded to the investment manager. We'll deduct that as well. So, what will the remaining? That will be the profit in accordance with clause 2 of the article 2 of this decision of each of the following: the qualifying investment fund or the real estate investment trust. So this is what is this? We're talking about the profit of or the net income of the immovable of the fund. Any exempt person under paragraph F, H, and I of the clause 1 of the article 4 of the corporate tax law. So this is the mother article of exemption, if you remember, right? Under article 4, we had different clauses that were there, F, H, I of clause 1. If we want to see that, we should be able to see that as well. Let me open that quickly so that we remember what we are talking about. Boss, your phone is,
It's not me.
I don't know. Okay. Okay, just hold on a second. Let me open the corporate tax law. Federal decree law. Just to recall, uh, yeah, there it is. So if you remember that article number 4, which was the mother article for exemptions, this is article 4, right? And
Mm-hmm.
in that article, what we had, the cross reference made is any exempt person under paragraph F, H, I of clause 1.
Mm-hmm.
F, H, I. Let us remember F, H, I. Qualifying investment fund. This is F. H,
Mm-hmm.
a juridical person incorporated in the state wholly owned or controlled by the exempt person. Here, the mention of H is with respect to F because it's in here, F is identified here, right?
Mm-hmm.
Wholly owned subsidiary of the qualifying investment fund. And then there is I, any other person, as determined by the cabinet, right? So that's why F, H, and I, three points that were mentioned here.
Mm-hmm.
So any person that is exempt, uh, all of that we are studying, this is the concept being explained of the immovable property income. Net realized profit derived from the various types of immovable property income which is located in the state as recorded in the financial statement, and after that we have to reduce the investment manager's income from it as well, and that will give us the immovable property income. uh, for each of the following qualified investment fund or real estate investment trust, as the case may be, any exempt person under Article 4 that we just saw, which is investment fund, their subsidiaries, and any other person from identified by the cabinet, and wholly, directly or indirectly owned and controlled by the qualifying investment fund or the real estate investment trust. Okay. Then what do we have next? Immovable property percentage. The value of the immovable property located in the state, the value of the immovable property located in the state held by the qualifying investment fund as percentage of the total value of the assets of the qualifying investment fund. Uh, Immovable property percentage, it's the value of that immovable property which is located in the state, which is UAE, held by the qualifying investment fund. uh, this investment fund holds that investment, owns that investment property a- as a percentage of the total value of the assets of the qualifying investment fund. The value of the investment property located in the state and the total value of the assets shall include the immovable property in the state and assets held by any exempt person specified under paragraph FHI. This, you know, so the qualifying investment fund, their subsidiaries, and any other person identified by the cabinet. So what are we talking about? This is an immovable property percentage. So how much percentage of income relates to immovable property that is owned by a qualifying investment fund? Does this make sense? Can if you want, we can go over this particular point again.
No, it's okay. What is a percent?
Sorry,
What is a percent?
there's no percentage identified here. This is only definition right now that we are going through. The value of the immovable property located in the state held by the. So what is this? They're saying what percentage of the overall, qualifying investment fund is that immovable property? That's called immovable property percentage. Do you understand? Value of the immovable property located in the state held by the investment fund as a percentage of the total value of assets of the investment qualifying investment fund. Does this make sense now?
Yeah, okay.
This is percentage of the total value of assets, immovable property percentage. Now, there could be a situation that only 10% of it, of the overall assets, comprises of immovable property. That's the immovable property percent. 10% is the immovable property percentage. Okay. Why? Because this 10% is going to be utilized soon. You'll see that. Value of the immovable property located in the state, the value of the immovable property located in the state and total value of the assets shall include the immovable property in the state and assets held by any exempt person specified under paragraphs FHI. Value of the immovable property located in the UAE and the total value of the assets shall include the immovable property in the state, which is in the UAE, and assets held by any exempt person. In this investment fund and its subsidiaries, whatever the assets held, they will be considered for the purposes of this article. And wholly directly owned subsidiary, that also has been addressed here. So in short, what we discussed was a percentage of the overall assets portfolio of the qualifying investment fund. That is the immovable property percentage. Then real estate investment trust. This term shall have the meaning provided for it in the relevant legislation in force in the state. So real estate investment trust will mean this term shall have the meaning provided for it in the relevant legislation in force. So we have a real estate investment trust legislation as well in the UAE. But in simpler words, it's an investment trust which offers units for the investment purposes, and they are usually listed as well. Have you heard about this point before?
Yeah, yeah, REIT.
REITs, yes, famous REITs. Now, what about net profit? Now, again, we know the concept of net profit, but it may have a unique meaning. The net profit as recorded in the financial statement, the net profit as recorded in the financial statements in accordance with the arm's length principle and in proportion to the investor's ownership interest in what was that? And in proportion to the investor's ownership interest. So we are considering the proportion of the ownership, investor's ownership interest, the net profit as recorded in the financial statements. So, and then we look at the percentage of the ownership interest. And after excluding the income attributable to the investment manager in accordance with the clause 2 of Article 2 of this decision, investment manager's income has to be, whatever compensation we give to the investment manager, that will be deducted out of it, of the qualifying investment fund, and any exempt person under paragraphs F, H, and I of clause 1 of Article 2 of the corporate tax law, and wholly, directly or indirectly owned and controlled by the qualifying investment fund. So basically, in simpler words, after due deductions and expenses and everything, whatever the profit comes in and complying with the arm's length principle, what percentage of the ownership interest a taxable person has, that will be the net profit. Ownership interest, rights and interests of any kind directly held by the investor in a qualifying investment fund, a real estate investment trust, or a trust, or a third category qualifying limited partnership. Percentage holding, simple. Okay. Then we have another thing, qualifying limited partnership. It's another investment vehicle. What is that? A limited partnership, that is a juridical person. So it's kind of an LLP established pursuant to the relevant legislation in force in the UAE for the sole purpose of collective investment under a legal framework that explicitly allowed for the establishment of such partnerships on or before 1 June 2023. Why this date? Because that's the date the corporate tax law came into force in UAE, right? So if we are talking about a limited partnership, that's properly a juridical person, and it was formed under a proper law. Usually DIFC, ADGM, they have limited partnerships structures for the sole purpose of collective investment under a legal framework that allowed for the establishment of such partnerships or any other legal framework as may be prescribed by the minister. In short, it is an LLP, and it should comply with the qualification conditions. Corporate law, we know already. Corporate tax law, what is the meaning of that? Now, these were only the pre-context definitions. Now we are going to get into the real article. For example, the first article 2, conditions to exempt a qualifying investment fund from corporate tax. That's the first condition. How will a qualifying investment fund be exempted from corporate tax? An investment fund, with the exception of a real estate investment trust, shall meet all the following conditions in addition to conditions under clause 1 of article 10 of the corporate tax law. Let me read again. An investment fund, with the exception of a real estate investment trust, shall meet all of the following conditions in addition to conditions under clause 1 of article 10 of the corporate tax law. This article 10 is qualifying investment fund. Do you remember this point? The article 10, last case of exemption. So there are conditions already provided in that article. Do you want to look at it? Let's look at it. I will go to article 10, which is the last case of exemption in the corporate tax law. Can you see this?
Qualifying investment.
Qualifying investment fund. You remember article 4, mother article of exemption?
Yeah.
From
Yeah.
article 4 until article 10, I'm going to repeat. From article 4 until Article 10, all articles relate to exemptions only,
Exemptions. Yeah,
right?
it's chapter 4. Yeah.
This is chapter 4. Yes. And the last article of the exemptions is for qualifying investment fund. What we are reading right now, that decision that we are reading right now, decision number 34, that addresses qualifying investment fund itself, right? And in this article, it says an investment fund may apply the authority for exemption from corporate tax as a qualifying investment fund, where all of the following. These are the conditions that the qualifying investment fund needs to meet. What are simple conditions, not investment fund. You have read this, by the way. So many times you have read this. Even before coming to me, you probably had some idea. The investment fund uh, or the investment fund's manager is subject to regulatory oversight. Remember this of the competent authority. It is a regulated fund, right? Remember? And then the
Yeah,
second condition
publicly
was
available. Yeah.
publicly available or traded on a recognized stock exchange.
Stock
You call
exchange.
it publicly available, but that's not the nomenclature used by the law. It says interest in the investment funds are traded on a recognized stock exchange. Rather than saying publicly available, which does not exactly reflect the meaning of the corporate tax law, use this word, traded on a
Mhm,
recognized stock exchange. Don't say publicly available, say traded on a recognized stock exchange. Okay.
mhm.
Or are marketed and made available sufficiently widely to the investor. Fine. So these are two initial conditions. What are the third and fourth conditions? The main or principal purpose of the investment fund is not to avoid corporate tax. Okay, fine. That's a general provision. That no tax avoidance. It is already embedded in every single article of the UAE corporate tax law, for that matter. And then any other conditions. So if you really think about it, C and D are generalistic conditions. These are the only two conditions. Am I right?
Yeah.
Yeah. So if we remember this point, that this was the conditions proposed by Article 10. Beyond this, is there anything else? Only one more. It says, for the purpose of monitoring the continued of qualifying investment fund, the authority may request the relevant information or records from the time. Not so it's okay. Fine. This is also not. This is a condition, but it's not
Yeah.
very
FTA may
complex.
request for relevant information or record
Yeah, yeah.
verification.
My information request, that's also a kind of a journalistic. That was all about Article 10. Now let us go back to the what we were looking at, the cabinet decision number 34. So let's now read. An investment fund, with the exception of a real estate investment trust, shall meet all of the following conditions in addition to the clause 1 of Article 10, which we just saw. Four conditions out, actually five, but only two of them are like very specific, right? Recognized stock
Yeah.
exchange, traded on recognized stock exchange, and what was the other one? For, one was regulated regulation. One was regulation, other one was widely available.
Regulated.
Yeah, right. So in addition to these conditions, more conditions have been provided by this decision. Okay, let's go through this. In order to apply for the authority to be exempt from corporate tax as a qualifying investment fund. Now, what are we talking about? We are talking about the exemptions. What are the other conditions? The principal business or business activities conducted by the investment fund are investment business, and any other business or business activities conducted by the investment fund are ancillary or incidental to the investment business. So, principal business or business activities conducted by the investment fund are investment business. First thing, this is the SIGA, core income generating it. But any other business or business activities are ancillary or incidental to the investment business. So basically other income, right? That's the first condition. These are additional. We should remember what we are studying is additional conditions. Okay.
Okay.
Second condition, the investors
Additional
must,
conditions to the clause 1, right?
sorry.
Additional condition to a clause 1 of the
Yeah,
article.
correct. Yeah, clause 1 of the Article 10. So in
Mhm,
addition to,
mhm.
okay. Second condition, the investors must not have control over the day-to-day management of the investment funds. So investors should not have control, okay, over day-to-day management of the investment fund. Then if they don't have control, then they will enjoy the exemption. Okay. What is the third condition? To provide its investors with all information, documents, or data necessary for the purposes of calculating their taxable income, adjusted pursuant to this decision. So okay, fine. This is a kind of a generalistic. The to provide its investors with all information. So the investment funds will relay all. You know that menu on the website called investor relations. Have you heard about it? Have you seen it? Many listed entities. If you open the listed entity on the menu on the website, you will find investor relations. And if you click that menu, you will find all the financial information, the audited financials, board of directors report, this, that, all information. So that is
The
this
official
guide.
website of the company. Yeah,
Yeah,
I've
right.
seen it.
Yeah. So to provide investors all information, documents, and data necessary for the purpose of calculating their taxable income. So that information will be made available to the investors. These are the additional conditions. For the purposes of applying paragraph A of clause 1 of this article, paragraph A of clause 1 of this article, the following provisions shall apply. What is the paragraph? The principal place shall be investment business, other things will be ancillary. That was the clause A. So the following provisions shall apply. Where the business or business activity of a resident investment manager are attributed to a resident investment fund, where the business or business activities of a resident investment manager are attributed to a resident investment fund. The taxable income of the investment manager shall be adjusted to include the net income attributed to the investment fund from such business or business activities in accordance with the Article 20 of the corporate tax law. So this this point is addressing the investment manager's income. Um, did this was there any mention of investment manager in clause A? No, it was not. So this is a standalone. It's a new additional thing where the business or business activities of a resident investment manager are attributed to a resident investment fund. Taxable income of the investment manager shall be adjusted to include net income attributed to the investment fund from such business or business activities in accordance with Article 20 of the Corporate Tax Law. So basically, what they're saying is there will be an adjustment made to the taxable income of the investment manager for such a resident investment fund which that manager is managing. So what kind of an adjustment would that be? That we have to see whether that investment manager income will be, that's not, we're not addressing whether that investment manager's income will be exempted or otherwise or whatever it is, but there's an adjustment that will be made pursuant to Article 20 of the Corporate Tax Law. Let's leave it at that here because our original objective is something else right now. So am I, you concur with me? We should move forward with this.
Yeah, please proceed. Yeah.
Okay. B, a business or business activities of an investment manager. So this entire thing is about investment manager. Business activities of the investment manager that are attributed to a resident investment fund. We talk about an investment fund which is a tax resident of UAE, right? Shall be considered to be investment business where they meet one or both of the following conditions. So it will be considered as an investment business if they meet these two conditions, one or both of the following conditions. They are subject to corporate tax in the state through the investment manager. Now you should also remember one very important point here. Why the word investment manager is being repeated here? Do you know why? Because under Article 15, if I remember correctly, of the Federal Decree Law of the main corporate tax law, we had one article here, Article 15, if I remember correctly.
Yeah, there's two things, investment fund and investment fund managers. There are
Yeah,
two.
the
Hmm.
investment manager exemption. Why
Yeah,
was
yeah.
this exemption there? Actually, it was not investment manager's exemption directly. It was an exemption awarded to non-resident person's income, saying that just because they have given their money to an investment manager, it does not create a permanent establishment for them. That was the concept of this article. Yeah, okay. We can quickly run down. So just to recall our memory that what was this article about. For the purpose of clause 6 of article 14 of investment manager shall be considered an independent. See, you see this? That's the what you very rightly you earlier on identified the type of permanent establishment. What did you say at that time? A dependent agent, right? That's what you said.
Mm-hmm.
Here,
Mm-hmm.
the article clarifies that this investment manager shall be considered as what?
Independent.
Independent agent. So, will that create a permanent establishment for the non-resident person? If the investment manager is
Mm-hmm.
independent agent, then can he be, can that investment manager be called the dependent agent of a non-resident person? No, he's an
No, he
independent
cannot be
agent.
called as a non. Yeah, he's an independent. Yeah.
So, is there a permanent establishment being created for this non-resident person in
No,
UAE?
no.
No, that is the whole point of this article. So
Mm.
it's basically protecting or defending non-resident person. They're
If you
saying that,
appoint dependent, it becomes an P.
exactly. If you appoint the dependent, it becomes a PE.
Mm-hmm.
Let's go through this quickly. Yeah, investment manager shall be considered as an independent agent when acting on behalf of the non-resident person, but he has to meet these conditions: A, B, C, D, E,
Mm-hmm.
F, G. All of these conditions have to be met. What are those
Mm-hmm.
conditions? Investment manager is engaged in the business of providing investment management or brokerage services. Okay, fine, makes sense, common sense point, right? It should be licensed properly. Investment manager is subject to regulatory oversight of the competent authorities. Okay, that also makes sense. Fine. Maybe central bank is checking it, or maybe FSRA or Fed or DFSA, Dubai Financial Services Authority, or Financial Services Regulatory Authority. DIFC or ADGM guys are looking over their shoulder, right? So it is a regulated investment manager, right? Two conditions clear. Let's move to the third condition. Transactions are carried out in the ordinary course of the investment manager's business. Okay, it's a day-to-day transaction situation. Investment manager has multiple clients, so no special thing. So that okay, that also is pretty explanatory. Until now, it's all clear.
Yeah.
Then what is the next? The investment manager acts in relation to transactions in an independent capacity. Yes, as I said earlier, multiple clients are there. So it's not like really he's not like totally dependent or begging on that one uh, investor, right? So investment manager is acting in an independent manner. Fine. Okay. So that was also the investment. Then the next condition is investment manager transacts on arm's length basis. Right. Okay. So I mean, they are conducting business on an arm's length basis. No special treatment, discounts given or overpricing is given. Happens by the investment manager. They could, what kind of a tax avoidance happen by involvement of an investment manager? Don't you think an investment manager could really, really start charging huge amounts in advisory and in, commissions from the non-resident person?
Yeah, it usually happens on
No,
percentage.
no, boss, hold on. I'm talking about constructing a fraud, a tax avoidance. You getting my point? An investment manager would artificially inflate the compensation from the non-resident person. You understand? And
How is it?
huge.
How is that possible? Like,
Yeah, I mean, I'm conducting investment business. I'm giving investment advisory. You know,
mm-hmm.
so non-resident person just gives you you are the investment manager, let's say, yeah.
Mm-hmm.
Clever non-resident person, a mature, मतलब खिलाड़ी किस्म का बंदा, he calls you, says, boss, can you do me a favor? Just give me some, invoices, not real invoices, but just, just provide me some serious level of invoices. uh, you are not very good in corporate tax, so you don't really understand why he is saying that. So you tell him, okay, I can do that, but what are you going to do with this, inflated invoices? Do you know why he's asking for these heavy duty inflated invoices on investment advisory, managing the business and this and that? Why is he doing that?
To reduce tax.
Yes, obviously. Because that
But how?
investment manager, that investor, non-resident person investor,
Hmm.
is has a risk that a risk that chances are that I may tomorrow I may be subjected to corporate tax. I may, all these conditions might, you know, this is investment manager's exemption, where where the non-resident person, uh, where this investment manager is not becoming the permanent establishment of the non-resident person. Until this point, it's okay. But what if other conditions are there? As we can see right now, that there are other conditions under Cabinet Decision number 34 that we are studying, and there is a risk tomorrow. It is too complex an area. I'm worried that non-resident person tells you, I'm worried tomorrow. What if I become subject to corporate tax? So I want to safeguard it. So I want you to give me like heavy duty invoices, so that even if I become subject to corporate tax, I will still be safe. I will probably be in losses. So in summary, bhai, the whole point is that sometimes investment managers can, avoid that arm's length basis to create undue advantage for the investors. Okay.
Isn't it this day one of contract as an investment manager that you put every payments and terms and conditions on a percentage base, and how does an inflated price can
But hold
happen?
on,
I'm not
hold
saying
on,
it is
hold
not
on.
impossible. I'm not saying
No,
it's
no, no.
impossible, but
Investment manager, why are we treating investment manager as a very limited scope engagement? An investment manager can, in parallel, be an investment advisor as well, right?
do you see any investment manager charging on a percentage or on a flat based?
No, no, there are both. Why? There are both. Yeah, I can later on. I'll share one article with you that is written on the prudential regulations issued by the DFSA for investment management and a lot of other things.
You mean a flat service fee, not a percentage on the
Both
returns?
things. Why? Both things. Investment managers charge both things, and you have to look into the prudential regulations to open your mind. Right now you're thinking very in a very very limited it's a huge world out there. The investment manage There are so many different categories of investment management provided there. Different categories are there. A dozen, too many categories are there. Dozen different categories are provided, tiers and categories and this
Oh.
and that.
No, I'm just looking
and
at the
and
larger
and
aspect.
hold on, and not only the categories, too many categories are there, but if you go into the prudential regulations of it, you will be surprised to see the number of different types of income that will be generated. And it is definitely not only a percentage, always. No, it can be a percentage, it can be a fixed fee, it can be other modus operandi as well. Even there is discretionary powers granted to investment managers. So they
Yeah,
can
that's
take a call, you
Yeah,
know.
I get it. But on a larger scale, if you look into it, how does the investment manager, his narrative of motive is to make profitable for the clients, and his service fee would gonna, inflate reduce the taxes part for the client. How does it works? Because my major criteria of my role is to make what? Make my client profitable and be stand out from the other fund managers, right? So why would I increase my price and make them low profited just for them not to pay taxes?
So these are two different things that you're addressing right now. As I said earlier,
Hmm.
there's a percentage commission, usually a commission on the amount of trades, for example, that the investment manager has done, right? But why?
Right.
What if there are other services other than trading only? As I said earlier, investment manager can be an investment advisor as well.
Yeah.
Ancillary activities can happen.
Yeah.
Okay.
Yes. I totally agree to the point. I'm not saying, see, it's not about, I'm right. This is the question is run in my head, like, and I asked you because the role of an investment fund manager is to primary role is to what? To make my clients profitable and make them invest in the right platform, correct? And my advisory service is gonna help them out, and I earn some uh, money out of that.
The tax, when you create something
Mm-hmm.
for the purposes of tax avoidance, okay, then this, what you just said, it becomes secondary. You get my point? When the intentions or the concept behind it is different, when the whole point of it is tax avoidance, then who cares if the investment manager is, achieving the real results or real goals of the idea is different.
Example scenarios of this situation, like what? Like, and a client goes
I
to a
would
fund
advise
manager and
you,
say,
I
yeah,
would advise you to read a novel of John Grisham, The Firm, and watch the movie as well, so that you understand how inflated billings can happen. The whole point of a non-resident person aiming to avoid tax, there are a dozen ways, more than a dozen ways, through which people can aim to apparently do investments in a jurisdiction and then end up paying a lot of money fictitiously. That's the whole point of tax avoidance. It is all fake. So it is actually goes beyond tax avoidance. It's tax evasion. But avoidance means staying within the law. So it will not, invoices may not be fake. Invoice may be genuine, but it may be bogus, meaning it is inflated, heavily inflated invoice. So the whole objective is that firm, that investment manager, my dear, itself was formed for the purpose of tax avoidance. Then what are you going to do? The non-resident person said, okay, let's create the damn thing. Let's create the damn mechanism for avoiding tax. They created the investment manager for this purpose. Then what are you going to do, brother? Where does the whole point of being profitable and all that went? Then the investment manager will have
then it's a
only one.
regulatory problem, right? So
Yeah,
why are we
and
looking at it? It's a regulatory problem. Like in every
I
regulatory, you have to look into
this
this. There's
whole this whole video is being recorded. Otherwise, I would say many other things, which I will tell you privately. Okay, I can't say it out loud, but there are issues. Let's put it that way. Okay.
Mhm.
Uh, it happens, and it happens right under the nose of the regulator sometimes. Okay. So that's the whole point of tax avoidance, my dear. It's very extremely clever. President Barack Obama's wordings are relevant here. You should read those wordings. Where what he said about the Cayman Islands, for example, said in one entity has addresses for, I don't know, so many thousands of taxpayers. So either it is the biggest building in on the face of the earth, or it's the biggest scam. And I think we all know what it is. These are the words of Barack Obama. Check later on. So that's how it happens sometimes. Investment, it happens sometimes. It happens right under the nose of the regulator. But anyways, let's not waste time on that anymore. Let's move forward. Let's finish this, huh? Shall we?
Mhm. Mhm.
So
Yeah.
yeah, we can. You keep that. You note whatever questions has not been answered, and we're going to debate and discuss if you want. We can do that. That's not a problem. The investment manager acts in relation to the transaction in an independent capacity. We saw that as well. Investment manager transaction or arm's length. We discussed that. Last 2 point. Investment manager is not the non-resident person's representative in the state in relation to any other income or in relation to any other income or transaction that is subject to corporate tax for the same tax period. Yeah, this is a key point here. Sometimes, the non-resident person might say, "Oh, boss, can you please represent me? Can you become a proxy representative of mine in the company? Why don't I have presence there?" Now, investment manager has to be very careful. You can't represent that non-resident person in the UAE. in relation to any other income or transaction that is subject to corporate tax in the same tax period. You see this point? How big a repercussion can representation have on an investment manager? It could make that investment manager a permanent establishment. So it is
Mm.
specifically addressed. Any other such conditions. Okay. So anyways, this what we just read, and transactions also are defined later on. What we just read was basically the conditions that must be complied so that the investment manager does not become a dependent agent, permanent establishment of the non-resident person. Why were we reading this? We were refreshing our memory for the purposes of investment manager exemption as to what it means in the corporate tax law of UAE. And why were we doing it? Because we were studying the cabinet decision number 34 on the qualifying investment funds and qualifying limited partnerships. We have reached to a point that we are on the Article 2. Today, we are going to stop at this point itself. And the next,
Mm-hmm.
when we resume, inshallah, in the next session, we will start from this decision itself. Okay?
Ah, okay.
Okay. So today we are
Makes
going
sense.
to stop here. Okay?
All right, sure.
Okay. Okay. Take care then. Thank you very much.
Thank you.
Assalamu alaikum.